What's up? I'm Dan Fredenberg, and this is another Chance Encounter.
Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon. I understand that there are power lines that are getting kind of close.
What's up again? This is Dan Fredenberg, and that there is a commercial real estate building. Fun. Yeah. So that was a neat little pet project a while ago. I think it shows a little bit of the tongue in cheek, but let me tell you what's going on. This is a chance encounter. I'm joined today with Rick. How you doing today, Rick?
I'm doing great, Dan. Rick Martin, by the way,
Rick Martin. Rick
famous
Martin.
name.
There you go. Very famous name. Make sure that you get that. It's in the description anyway. But I've got some really exciting news for you, Rick. I don't know if you're aware of this, but today we are joined by my very favorite member of the audience. And why is my favorite audience member here? It's because this is a chance encounter where I interview commercial real estate investors. That means deal sponsors, buyers, sellers, all that kind of fun stuff. And you may ask yourself, why would you want to do that? And the answer is if you've ever heard of private off market deals, the ones that you're not supposed to publicly discuss, then you know that you need documentation of your prior substantive relationship, or else the SEC will get ants in its pants and they could take your business away unless you're only working with accredited investors and blah, 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 blah. But the good news for you is you will take away many different ways to more effectively communicate on the subject of commercial real estate, and you'll also know how my guest fits into those deals. But before we get too far into real estate, Rick, do you want to introduce yourself a little bit?
Well, yes, my name's Rick Martin, and I'm the principal and founder of Fortress Federation Investments, and we focus on multifamily. We're not going anywhere. We're still focusing on multifamily, although activity has definitely been a lot slower. We're just, the sieve has grown tighter. It's tough to filter good deals through, and so we have only done one deal this year. We only did one deal last year, and we mostly focus on value add multifamily down in mostly Texas, some in Florida, a bit in Arizona, where they're fairly landlord friendly, and also just a lot of good population growth happening in those
Mhm.
markets. So we've kind of settled in that region, and we try to keep it 1980s and above. Um, you know,
Mhm.
Sometimes I'll get an opportunity that it looks like an 80s product or an even 90s product, but it'll be 70s, and I just gotta, I don't mean to discriminate, but there are a lot of things that can go old with or go wrong with older properties. So, but
Absolutely. I love that. I love that. So the first segment that we go through here, I'll take off the banner here. It's the five distinct motivations. And before I do that, I always have to say, but wait, check your eight. Hey, Rick, I don't know if you know how to do this or not, but maybe you can see through your camera and into the user's device, and there might be this big, hideous subscribe button if they haven't, and then maybe they want to. Okay, it's a dumb joke, but whatever. The
they should
five
do that.
distinct. Yeah, it's a good
Subscribe,
idea, right? Yeah, good
subscribe. You got to
call.
point down,
Right,
ring
exactly.
that
It's
bell
just
or whatever they say. Do that.
exactly, all that kind of stuff. Now, the five distinct motivations. At this point, I've spoken to hundreds of different real estate investors, deal sponsors, buyers, sellers, all that kind of fun stuff. And everybody has their own unique why, but at the same time, I found that they fit pretty neatly into these five categories. And the reason why it's important for people in real estate to know each other's motivations is because at the end of the day, a typical commercial real estate deal, like a multifamily deal, it'll take months to close, it'll take years to go full cycle. So you need to have some sort of idea of what's in it for you, what's going to keep you from throwing in the towel if if the going gets tough, as they say. And the first motivation that I have is preservation of purchasing power. What's that? Well, some people, they already have a portfolio of assets and they rely on the proceeds of ownership in order to make ends meet. So that means they don't have to have a job. They're perfectly fine just taking those proceeds. But if you're in that comfortable situation, some people might ask, well, why would you make another acquisition? And there are a couple scenarios that stand out. One of them is if inflation rears its ugly head, well, that's going to eat away from the purchasing power of your cash flow. So it's going to be time to make another acquisition. The other circumstance, and I think it applies these days, is if there's extreme distress or an asset crash and you can buy at a particularly steep discount, that's another thing that would make people in this position more likely to move. But the emphasis is that they're not necessarily ready to pull the trigger at a moment's notice. And of course, you should always try to get the biggest discount possible on your acquisition. But admittedly, preservation of purchasing power, I'm not to that point in my commercial real estate career. So, more accurately, I'm trading time for wealth as a function of my background in technology. Now, if you are pursuing higher wages, higher salary, you also get taxed more than anybody else. And I used my CRM and online funnels and outbound marketing tech agency skills to eventually work for a guy who was flipping 10 houses a month and work with all of his online activities. But what hit me is here he is, he's making way more money than I am, but he's able to uh, use the tax code to end up having a smaller bill. And so that's what I'm more interested in, is just getting little slivers of deployed capital, aka wealth. But that's a little bit too subtle for some people, especially youngsters. Frequently, they want to hustle like crazy right now and then retire early. Other people, it's not so much retirement so much as being able to control your schedule. And that's a great appealing option to many people. And I think a mistake that many people make is they think that secretly this is the motivation of everybody. They're secretly trying to find a way to retire as quickly as possible. And I assure you, that's simply not the case. Like, some people are just fueled by ambition. They want to buy their entire hometown. They want that generational wealth to make sure that their great grandchildren never have to hold a day job. And that is why they're going to hustle into their 90s. And of course, in some circles, that's vilified. But the fact is, if you want people who are going to take care of a property and make sure it's taken care of and provide real benefit to people, then somebody needs to stick with it and be in for the long haul. So that's why they're great people to have on a GP team. But the last of the five motivations is help people who need it. And what that's all about is some people, rather than focusing on their own generational wealth, maybe they've picked a sector of society, or maybe it's the environment, or maybe animals. Who knows what it is? But they've realized that there's a massive financial component to making a big difference, and that's why they're making their commercial real estate acquisitions. So, Rick, I understand that you have a fund, I believe, but so that kind of pigeonholes you into a couple of these motivations. But what combination would you say describes you best?
Oh, I definitely want to buy my hometown. I want to buy Seattle. In fact, I have my Seattle Supersonics shirt here, and when I buy Seattle, I'm going to bring the Sonics back. And
All right.
I'm in Oklahoma. That means I'm coming for you. For those that don't know, the Oklahoma Thunder, or formerly the Seattle Supersonics, and they robbed us. They robbed us. Um, no, I actually forget everything you said. You need to bring all the options up on, so I can like review.
Sure,
Um,
sure,
but
sure.
I mean, if you're asking what my why is in
Mhm.
general, um, I would basically say, "Good morning, son. Let's get you dressed. All right, here's breakfast. All right, I'll see you in 12 hours." And that would be that. And I would come home and I, kids eat early, so I'd miss dinner, and so it would be basically be tuck them in and say good night. And so I knew that that had to change. Plus, my wife needed more help, and um, I, you and I both have experience in the post-production industry, and it can be a grind. I was driving from Redondo Beach into Hollywood and on a lot of nights, and so the commute was part of it, but also it's just the grind of being in front of a computer, your eyes getting strained, getting a headache, and honestly, it sounds glamorous, working on Hollywood pictures and television shows, but 90% of it is not glamorous. It's just kind of a grind, and you know I never had full creative control, and that's another part of it. Not only being able to control my schedule, but just kind of have a inspiration on having a vision that you can kind of see A through Z. Because I'm a creative guy, and that's important to me. That's gratifying. But just it's similar to yours. I time is super important. That's the number one factor. Time is more important to me than money. Um, I don't need a Learjet, a simple Cessna will do, maybe a helicopter.
Hmm.
Um, but it's more about time, and that that's made me happy. Now it's not always, this past year has not been stress free,
Yeah.
um, because of the way market conditions are. It's a transactional business, right? And if I'm not transacting, then there's no money coming in, and that's a little scary. But still, I would not go back. I like the way
Mhm.
things are, and I know that things are just on the precipice of really improving in terms of multifamily real estate.
I love it. I love it. And it's funny because after that motivation piece, I always feel like this segment is a little bit of a wet blanket because it's like, hey, yeah, it's wonderful. These are my aspirations. Let's talk about risk. And the origin of this particular question, it's more important than it may appear. When you go through when you're involved in one of these private deals, these ones you're not allowed to publicly discuss,
Hmm.
there's a questionnaire that everybody who's involved as a partner needs to fill out. The securities attorney will require it, and if there's no securities attorney involved, then that's a huge red flag. So be careful of that. But when I was going through the questionnaire, there was one question in particular that I felt it lacked utility. I couldn't use any of the available multiple choice responses and actually, really rely on it. So I made my own one, and it's a fill in the blanks question. It is: there are many popular investment asset classes, but I think blank is too risky. So, Rick, it can be inside real estate, it can be outside real estate, it could be both if you want. What's too risky for you?
I think dry cat food. Um, I think cats. There's a trend. They're going towards wet. I think they're millennial cats. For the most part. Um, a lot of the older cats still like the dry little friskies and whatnot, but I there seems to be this, hard line drawn in the sand. Like, I'm only eating wet food, and I'm not going to eat this dry stuff that you're going to feed me. And
Mhm.
so I think the days are numbered for dry cat food.
Yeah, that's fascinating. Now, did you have? I think I'm gonna have to lean on something for real estate too. Is there anything in real estate? You're long on multifamily. So, are there any other categories where you just feel it's more like gambling, or just basically there's just too much risk involved?
Well, I'll say two. Um, One is real estate, and then one is crypto. Um, the thing with crypto, if you don't understand it, just stay away. You're just gonna lose your shirt. Ask me how I know, by the way. I don't understand crypto. I still don't get it. I mean, it's nothing. It's nothing, but it's worth a lot. Yeah, the blockchain, all that. No, I think essentially what I'm saying is, if you don't understand something, that goes for multifamily too. Just stay away from it. It's not going to end well. In terms of
Hmm.
real estate, I hate to beat up on it, but I think commercial office is still quite risky. There's a lot of people saying, well, we can just convert it to multifamily. And yeah, well, the footprints are just so different in most cases, not all, but um, and yes, people are going back to the office, but not entirely. And who knows? Maybe we're not out of the woods entirely with the pandemic and whatnot. But I know people got a whiff of working from home, and they like it. And there's a lot of distress. I guess if if you really know what you're doing, and that's your sector of commercial real estate, you're going to get a heck of a deal. That's for sure. Everything is on sale. So, you know, I'm probably going against Warren Buffett. When it,
Right.
you invest at the worst time. And right now, I feel like that in general. Right now, it feels kind of that pit in your stomach um, about investing in anything commercial real estate, and that's probably a sign that it's time to buy.
Yeah, yeah, I definitely get that. But let's talk about the favorite deal metrics. Now, I gotta share the fact that I didn't include this segment in the first couple hundred chance encounters, and that was because I know some people are more the front of house, the pretty face, the marketing person for the company, and they're not the person who's going to be quietly digging into the spreadsheets by themselves, testing out all the different assumptions that are done in the underwriting. But even if you are that front of house, that PR person, you're still going to need to know some of the numbers. And I want to make sure that if you interact with my guests, then you're basically speaking their language. So that's why I include this. And for anybody at home who is only listening and not watching, I'll read these out. It's not an exhaustive list, so you're welcome to add others. But the ones on the list are cash on cash, IRR, which is internal rate of return. Then there's cost per door, NOI, which is net operating income. Then there's the going in cap rate, the loan interest rate, which is especially important if you're going to be assuming a loan. I should also mention that the going in cap rate, that is really talking about what sort of discount are you getting right off the bat compared to similar properties that have been sold recently. But then I have occupancy, which is the inverse of vacancy. Vacancy is the enemy, but occupancy and vacancy, they're the same number reflected a different way. We have average income, which is where the property is located, the typical jobs of people who live there. Then there's the amortization period of the loan, the market versus in place rent, what's the difference between the two of them. Then there's the population growth where the property is located, so you have some baked in appreciation or demand factored in. The sponsor record, which is how many deals have already gone full cycle and how many deals are on the go right now. Then there's the waterfall, split, or exit, which is basically saying what happens to your investment after your capital has been returned and you're completely paid off, so to speak. Then there's the DSCR, which is the debt service coverage ratio, which is how much of the revenue from rents and amenities are going out the door immediately in the form of the loan. So, Rick, as far as that list goes, feel free to pick another one, but you want to give a top three or something like that?
hmm And did you say a lot of your guests have been like the pretty face of the company? Is that how you put it?
Fortunately, fortunately, no. I actually expected that most of my guests would be the pretty face, but it turned out I got way more people who were actual operators, actual
Mm,
deal sponsors, and things like that. But I often get different repositioners and locals, but
okay.
really part of what I'm up to is making sure that capital raisers don't say that they're doing it without an exemption or a fund or a license. So.
Or pretending like they're the operator,
No kidding.
because it's
Exactly.
different. It's
Right.
different. All right. Now, are any of these worth more? Like if I go with, let's see, which one do I like from a growth standpoint in terms of market deal potential? I'm glad you're giving me multiple choices because I couldn't. Um, in terms of, yeah, do any of these have, is this worth 50 points if I say market in place rents and then maybe like NOI is worth 100? Because I want to know that going in. Or are they all worth equal?
Yeah, yeah, they're all worth equal. Yeah,
Okay.
there's no points. We're using fake internet points on this particular game, but
Okay.
that's funny.
All right. So the first thing that I look at when I'm evaluating a deal, just from like, I know you got to start with the sponsor, all that, but I just want to know, am I wasting my time? Why even waste my time on a bad deal? So the first thing I look at is the delta between market and in place rents. And if it's like $150, I'm like, not worth my time. And well, it depends. I mean, if it is a core plus asset, and you're just looking for a good cash flow stream and not much upside, then maybe that's okay. But yeah, I want that delta to be pretty large if it's a value add
Mhm.
proposition. But yeah, from a downside protection, you definitely want to look at the sponsor record and the DSCR. Um, debt, the debt service coverage ratio, you just want to make for damn sure that you're nowhere near break even, that you have plenty of reserves to cover whatever downfall you're going to have.
Mhm.
And you just want to make sure that you're getting enough income to cover, more than cover that debt service. And then sponsor record is interesting because this year, um, sad to report, there are a lot of people with lengthy track records who are getting, having to hand back the keys on deals. And again, ask me how I know. um, and it's rough. And you think, oh, hey, look at their track record. And they've performed. Maybe they've performed for you well in the past. Um, if people, they say, you hear it over, oh, track record, track record, track record. Well, it's almost like you have to go back to before the turn of the century, because this recession, or I feel like it's a recession, like the um, just the distress that we're feeling right now in commercial multifamily, um, is bad, but it doesn't. It's apples to oranges when comparing it to 2008. And when you talk to someone who started in 2010, well, that was like the start of the gold rush. Um, so that's 14 years ago. Wow, 14 years. That's a lot of experience, but they haven't had to go through much. Now there was that weird thing, COVID, which completely screwed up the economy um, forever. I don't know if we're ever going back. Um, but that was, what they call the black swan event. That was just an odd situation. And yes, it was all hands on deck, and I felt sick to my stomach. Who knew when it was going to end, and if we were ever going to, they basically were, it was free rent, right? And how long was that going to last? But you know, with and it's kind of a dirty trick, I think. They're like, okay, we're gonna shut down the economy, we're gonna cut rates lower than they've ever been, they're gonna be negative, and then we're gonna tell you that we're not even thinking about raising interest rates, but lo and behold, a year later, they've skyrocketed to an unprecedented record amount. And not to let everybody off the hook, but that's kind of a raw deal, and they're purposely inflicting pain, and boy, we're dealing with it. And um, you pile on with inflation, and it is a challenge. And so I think when you check when they say track record, well, go deeper. Ask, okay, what's the most adversity you've had to face? How did it come out? Did you lose money? Be honest. Did you lose investor money? Um, if you were able to pull out of it, what did you do? And listen to that story, and maybe get a couple stories, because those are, you know, the good thing about the silver lining is, this is going to be a feather in the cap of those that survive, and don't have to, get foreclosed on, or have, numerous capital calls and whatnot. It will strengthen uh, the teams and the sponsors. So I think, limited partners, they should feel pretty good by Q1 2025.
Mhm.
I Let's hope.
Mhm.
Interest rates aren't doing anything, and it seems like They may not do anything for a little while. This is just everything is different ever since, anytime that you infect the free market with private, or excuse me, public, interference, it's econ 101.
Yeah.
It's just not gonna function properly. So who knows how long this will last? I got on YouTube and I said, oh, interest rates, we'll be, trending down here in a couple of years. Now I'm not
Mhm.
so sure, you know.
Yeah.
So boy, that was a long-winded answer, but you gave me three, so I divided it up.
Yeah, that works. That works. I don't worry. I was still just eating that answer up like a delicious subscribe sandwich.
I
You
thought you
you
got
were saying,
sponsored by Subway there.
yeah, it's a subscribe sandwich.
I
So
like it.
you just to be careful, and just another glorious moment for post production effects, right? Nice
Wizardry,
moment.
wizardry.
Wizardry, right? Exactly. But it's my reminder. It's time to bring out the Dan Does Deals Commercial Core Competency Cube, and that has the 6 different roles in a commercial real estate deal. And the benefit to you of going through it is that you can figure out exactly how my guest and other people in this space fit into a deal. And if you really, really want one, the good news is you go to dandoesdeals.com. There's this great big button. It goes straight to the PDF. You don't even have to give me your email address because I'm a dummy. So go ahead and get that and you can practice this. Let's get started with repositioners because they are by far the most visible people in commercial real estate. Why are they the most visible? They are curators of deals. They're doing all sorts of paperwork. They're looking at all sorts of deals. And one of the reasons why they have to do all that paperwork is because they're underwriting. There you go. There's the 506 BME code. Sweet. So the repositioners though, they are doing all this paperwork because first of all, they have to figure out whether or not the property is even making the amount of money that the seller slash broker claims it is. Because so they have to figure that out. But the bigger skill that's involved in being a repositioner is being able to figure out ways to find upside. And the most peculiar part, I'd say, of being a repositioner is you have to have a vast network of financiers who are people who do not deal with the residents or the tenants of a commercial property. They only deal with the paperwork, the owners, and money. And so the reason why repositioners have to have a vast network of financiers is because if you can secure cheaper capital, then that goes straight to the profitability of the building. So that's why they have to know lots of financiers. But the more typical spot that a repositioner is going to look to find upside is to get operations a little bit more efficient. Me personally, you may have heard a rumor about me, which is that I'm from the internet. So that means my contribution whenever I'm on a GP team, it has to be able to be remote based. And so the contributions that I've done in the past have to do with building web related assets. And then also, if there's, even if it's a bigger property where you have third party property management, then I throw my hat in the ring for that. Yeah, Rick is also big on this one as well.
I
And
had, I had a, I had a question for you. I thought,
sure.
weren't you from Canada? Aren't you from Canada?
Yep. Yeah, that's
Okay.
right. But I never bothered to do any. Yeah, I'm in Canada, and that's why I need to rely on locals. They're the boots on the ground, the people who need to be there in an hour or two, because that won't be me. And the repositioners are going to be spending a lot of money on things like optimizations, capital expenditures to make the building, the property more efficient. But the other thing they're going to do is involve a contractor team if they're going to upgrade the property because they have that expectation that they can fetch better, bigger rents from new residents. That's where the contractors come in. But the locals keep an eye on those contractors and the operations, make sure that nothing's getting sloughed, you're getting good information. But to explain the sixth side of the queue, it's best to do a hypothetical. So let's say you're thinking about getting into commercial real estate. Maybe you own a rental or two. Maybe you're a physician or an engineer or an attorney, something like that. And you think, hey, I know that I just have to put down my deposit and then I borrow the rest. So I bet my friends and I can pool 100K each and we could take over that 350 unit apartment complex down the street. Well, the bad news is that when you, the new repositioner, turn around to the financiers and say, hey, we want to buy that building for tens of millions of dollars. You don't happen to have, say, tens of millions of dollars you want to lend us, do you? Well, they're going to say, who's the sponsor? Who's the KP? What's that all about? So many mentorship programs and gurus, they really gloss over this piece of the puzzle. And that's why I think it's important to know. See, funds and banks, lending institutions and lenders, they're not going to let you make an acquisition and then run it into the ground with their money. So they're going to require that somebody in the fold already owns a similar asset. On top of that, you're going to need a certain amount of liquidity. And then among the GP teams, you're going to have to put up collateral of at least the amount of the loan. But if you have all those pieces, you got yourself a commercial real estate deal. So, Rick, I know you have a couple different pieces, but we have some virtual assistants who watch this show. Which pieces of the puzzle do you focus on?
Again, Dan, you need to like throw all these topics up in front of me. Um, I uh-huh. Go ahead.
Yeah, I think you do. I think you do a bunch of operations, which is the asset management itself. And then, of course, you're also a curator of deals, which makes you a repositioner. And then, of course, the sponsor part would be if you're signing with your own net worth, whereas
Yeah,
yeah, fund
I
managers would be more on financiers.
yeah, I think clarification on my role. I'm not a fund manager, by the way.
Okay.
I'm a co-GP. I'm not an operator. But that it doesn't say that I don't need responsibilities in the deal, right? So
Mhm.
we do provide like an extra layer of due diligence. So
Mhm.
what that means is, yeah, I have a bunch of just checklist of um, just sub-market analysis, things that kind of are pass and go on the deal, some kind of just high level stuff like, okay, kind of stuff that we're talking about, the delta between current and market
Mhm.
rents. And then if it seems like there's potential here, then I I'll take on the operating team's underwriting and just analyze it in its own model. See what makes sense. See what take it into my own model, write it, and see how that sort of matches it up. Are we sort of in the same ballpark? It's never going to be exact because different models have they just spit out different numbers, unfortunately. But it should be pretty close. And if it is, then I pass it to my commercial lead analyst who's been doing commercial underwriting for 30 years and man, he's good. He's a heck of a lot faster, that's for sure, than me. And
Mhm.
he is someone just to kind of pass some of the high level stuff on before we can save ourselves some time by not having to dive in the model if we don't have to. But so it's basically three steps of underwriting just to make the numbers pencil.
Mhm.
Um, other than kind of speaking about all the other forms of due diligence going through
Mhm.
the PPM and whatnot. Um, and then, yes, then I feel okay. I feel like I can sleep well at night offering this to any investor
Mhm.
that is, within my investor community.
I love it. I love it. And then as far as buy box goes, when people are asking each other in real estate what you're looking for, there's a geography component, there's a size component, and then there's a class component. When you're talking about geography, it's where is it, which states, which counties, possibly even which neighborhood. If you're talking about ideal, it's going to matter. Second one is size. In multifamily, you define size by the number of apartment units. And the reason why it's relevant to know this is because the type of group that's going to be taking over 10 unit apartment complexes are going to be fundamentally different from the ones taking over 150 unit apartment complexes. So that size is going to matter. Now, when it comes to class, I prefer the term desirability, but whatever. The two parts of desirability or class are the condition and the area. If you're talking about condition, it's how old is the property? How beat up is the property? Is it full of luxuries and amenities, or is it really a no frills kind of place to be? The other one, the area, because we're talking about residential and multifamily, the school districts where the property are located, they're going to be quite relevant. But every type of real estate is going to take the crime rate where the property is located into play, and then also the amount of traffic that goes by every single day, because that's what they really mean when they say location, location, location. But both the area and the condition are ranked in the same way as in grade school, where you've got A plus at the top, and then A minus, and B plus, and so on. So, Rick, as far as your organization's buy box, where are you looking?
Well, we keep it, well, we're looking in primarily Texas, and that goes in terms of cities, it goes into Houston, San Antonio, and Dallas. And there is certain, Houston, for instance, we step in the northwest quadrant of Houston. I feel like, away from hurricane, threat of hurricanes, flooding, that sort of thing. That's not to say that we don't have properties in other parts. But again, they're out of flood zones and whatnot. I
Mm-hmm.
mentioned the vintage that we got to keep it mid 80s and above. It's funny that's considered B class, but here we are, 2024. Going to be pretty soon. The things that you're looking for are the infrastructure. Does it have aluminum wiring? That's bad. That's I can't remember the exact cutoff, but it's something like anything after 77. Um, you're
Mm-hmm.
pretty safe. And goes for you don't want gas. You're looking for
Mm-hmm.
PEC, and you're looking for at least copper. So yeah, I would say, and also a unit mix. That counts. I pretty much 200 units and a, but the unit mix, well, there's a bunch of studios, and we won't be interested. Um, kind of the unit mix has to sort of tie into the area. If it's in a urban, so young professionals are seeking housing, want to walk to work, then one bedrooms make a lot of sense. But one bedroom in the suburbs where you have families and good schools, those aren't going to make much sense. So you're going to be looking for 2, 3 bedrooms. So it kind of, the unit mix has to tie in the surrounding area. Median income plays a role. Anything below 50,000, you better know what you're doing. And it could depend on the community itself. Definitely mid 30K. That's you know that's going to be sort of kind of war zone-ish.
Mm-hmm.
So
Mm-hmm.
yeah,
Okay.
I would say mid 80s above, but the unit mix kind of has to tie into the
Yep.
community.
All right, beautiful. And the next question on everybody's mind is going to have to be how to reach out. I know you're quite active on LinkedIn, so am I. I'm fortunate to have this pretty distinct looking last name, which makes it pretty easy to find me online, especially on Amazon, where you can see I have a few different books on different business skill building related projects and topics, I should say. But if you scan this code like Rick did earlier, that goes to the FAQs page at 506BME. And if you're looking to raise capital for your business, if you have a startup, you're looking to offer passive interest to people, I really encourage you to get educated on the rules of 506B, because there's a good chance that that's what you're going to have to rely on. The biggest thing is that you need documentation of your substantive relations, and 506BME will maintain that documentation for you. So if your laptop falls into the bathtub and the SEC comes knocking on your door, you still have that sort of backup available. But Rick, if people want to reach out, is LinkedIn the best way, or is there a website, a phone number? How should they make that happen?
Well, first, let me say your service is really cool. That's very innovative. I like it a lot. And in terms to answer your question, I would say, let's give the people something free, right? So go to fortressfederation.com /dad's guide. And you don't have to be a dad to get something out of this, because it's basically it has a lot of foundational multifamily um, rules and stories and hyperlinks, and it's packed full of good stuff. So fortressfederation.com/dad's guide, because I'm a dad and that's why I'm doing this.
I love it. I love it. And that brings me to my public service announcement. That's not for you, Rick. It's for you in the audience. If you've been watching this episode and experiencing searing pains in your eyeballs and like migraine like symptoms, I'm confident it's because of the downright hideous subscribe button that's just down there. And if you've got children like Zoomers in the house and they see that you haven't subscribed, they will judge you. I don't know if that matters to you or not, but me personally, full disclosure, the reason why I encourage people to hit it is because if enough people do, YouTube will actually start to pay for these videos instead of me. And I think that would be amazing. The trade-off to use my videos may show up on your list of suggestions, but you can go ahead and ignore those. I just want to thank you for joining me today because your time is really important to me. And Rick, thank you for joining. This has been fantastic.
Yeah, Dan, I think it's funny. Asked me what name do you want to go with, and I just said Rick. I'm not like Bono or Sting. I do have a last name, and next time, what's this called? StreamYard, right?
StreamYard, yeah, yeah.
Next time I'll probably include my last name, but for now I'll just be like a famous guy like Bono or Sting. Rick.
Or Cher, yeah.
Cher. Who else?
Yeah.
Who else?
Donna.
Beck.
Beck?
Maybe.
Nice,
Yeah.
nice. All right, cool, awesome. Thanks. Catch you next time.
Thanks.
Does nothing but put more money in the pot.
Right.
If we talk about just the investor side, I mean, Shane talked about the sponsor side a little bit. I'll talk about the investor side. Okay, so you want the most money in terms of return with the least risk. All right, you want to do it yourself, you can go get 13 or 14%. You're going to do all the underwriting, it's not going to be passive.
If you bet, probably not.
I think I'd have to bet at least 2,500 before they fold.
And the pot is
4,000.
4,000. Yeah, I think you're right, but I'd rather just check.
Okay.
First position, you have the right of collection and the right of foreclosure or sheriff's sale, wherever you're at.
Hey there, are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506B or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format, it checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, all that kind of stuff. So I hope to hear from you soon. Thanks a lot. Make sure you 506B me. Any syndicators, make sure you 506B me. Hi. Oh, hey, yeah, here's my code. You got your QR code scanner? Okay, yeah, oh yeah, just hold it right in the square there. Okay, cool. And now you hit open in browser. Okay, are you already logged into 506BME?
Yes.
Yeah, okay, cool. Yeah, so there's my video. So now I'm already on your watch list. So when you get back to your hotel, you can find out what my core competencies are and my level of sophistication. Sound good?
Yeah.
I love your hat. Real estate's a scam. That's really funny.
Yeah.
Nice meeting you.
You too.
506BME, everybody.